Have you ever thought sharing your money with someone could either bring you closer or turn into a total disaster? Opening a joint checking account sounds simple. Two people, one bank account, easy access. But here's the twist. What if one mistake costs you everything in that account? Let's break down the truth behind joint checking accounts so you can decide if it's the smart move or a financial time bomb. Stick around, because in just a few minutes, you'll learn one surprising rule about joint accounts that most people don't find out until it's too late. Number 1. What is a joint checking account? Really? A joint checking account is a bank account that two or more people own together. This means all account holders can deposit and withdraw money, write checks, pay bills, and view transaction history. It's like having a shared digital wallet. But legally, both people own every single dollar in it, no matter who put it there. Let's say Emily and Jake are a couple. Jake deposits $3,000 from his paycheck, and Emily adds $1,000 from her freelance gig. Even though Jake put in more money, both have equal rights to all $4,000. If Emily decides to withdraw all of it one day, she legally can. That's the reality of joint ownership. Number 2. Who typically uses joint accounts? Joint checking accounts are common among married couples, but they're also used by roommates, elderly parents and adult children, or even business partners. Here's an example. Sarah helps manage her aging dad's finances. To pay bills and track spending easily, they open a joint account. Now she can help him without juggling receipts or transfers. Sounds helpful, right? But now, technically, Sarah owns all the money in that account too. If she were sued or fell into debt, her dad's money could be at risk. That's how serious joint ownership can get. Number 3. The benefits that make it so tempting. Why do people still open joint accounts? Because when used wisely, they can make life way easier. Benefit 1. Simplicity. Instead of splitting every bill or Venmoing each other constantly, a couple can just use one shared account for groceries, rent, and Netflix. Benefit 2. Transparency. Both people can track spending, helping avoid secrets and build trust. Benefit 3. Faster access in emergencies. If one person passes away or becomes ill, the other can still access funds without needing a court order. Imagine a couple planning a vacation. They pool money into their joint account to save faster and book things under one card. Smooth, efficient, convenient. But don't be fooled by how easy it looks. Number 4. The risks that nobody talks about. Here's where it gets scary. The same joint access that makes things convenient also opens the door to big risks. Risk 1. One person can drain the account without permission, no warning, no refund. Risk 2. If the relationship goes bad, the money can become a weapon. Breakups and divorces can turn ugly fast when a joint account is involved. Risk 3. Legal or financial trouble for one person can affect both. If one partner has unpaid taxes, debt, or gets sued, the account can be frozen or garnished. Take Tyler and Matt. They were best friends and roommates. To handle rent and bills, they opened a joint account. But Tyler fell behind on credit card debt. One day, a debt collector froze their joint account. Matt lost access to his paycheck, and they both had to scramble. That's not just inconvenient. That's dangerous. Number 5. You can't control the other person's habits. Joint accounts require trust, a lot of it. But what if the other person has a spending problem? Let's say Jenna and Mark open a joint account. Mark loves gadgets. One day he blows $1,200 on a drone and a new phone without telling Jenna. She logs in to check the rent money and finds it almost gone. Mark didn't mean harm. He thought they had extra, but the damage is done. You can't set spending limits on the other person in a joint account. It's full access or nothing. Number 6. The real problem with accountability. In a joint account, if money goes missing, who do you blame? You can't say, "That was my money you spent," because legally, it's not yours anymore. Even if your paycheck went in, once it hits the joint account, it belongs to both of you equally. That makes conflict resolution tricky and emotional. If one person forgets a payment or overdrafts the account, the bank holds both parties responsible. You both share the consequences, even if only one person made the mistake. Number 7. Joint accounts after death, a double-edged sword. One reason people open joint accounts is to avoid probate after death. Let's say Maria and Tom are married. They share a joint account. If Tom passes away, Maria automatically owns the account. No legal battle, no paperwork delay. That's helpful in emotional times. But here's the twist. If Maria had children from a previous marriage and Tom didn't, the money may never go to Tom's family. The surviving joint holder becomes the sole owner. This can create legal and emotional tension among heirs. Number 8. Alternatives to consider. You don't have to go all in with a joint checking account. There are smarter ways to share money without risking everything. Option 1. Keep separate checking accounts and open one shared account for household expenses only. Each person contributes a set amount monthly, like $500 each. That account is only used for rent, groceries, or shared bills. Option 2. Use a budgeting app that links both accounts for transparency without actually mixing funds. Option 3. Grant view-only access or a limited power of attorney for elder care situations instead of full joint ownership. These approaches give you flexibility and security at the same time. Number 9. How to set rules before opening one. If you still feel a joint account is right for you, set clear boundaries up front. Decide who contributes what. Set spending limits. Agree on what the account is for and what it's not for. Communicate regularly. Hold monthly check-ins to review transactions and adjust plans. Make a backup plan for emergencies, breakups, or major changes. Think of it like a team project. You wouldn't start a group assignment without talking roles and expectations, right? Your money deserves that same clarity. Number 10. What the research says. According to a survey by TD Bank, around 76% of couples who share bank accounts say it improves their relationship. But the key word here is couples. When the joint account is used outside a romantic partnership, say, between siblings or roommates, satisfaction drops and risks rise. Data from Pew Research also suggests that financial conflicts are a top cause of stress in relationships. Joint accounts, when mismanaged, can amplify that stress. But when used intentionally, they can strengthen teamwork. It all comes down to how well you know the person and how clearly you define the rules. Number 11. Real-life horror stories and what they teach. Meet Lisa. She opened a joint account with her boyfriend, thinking it was a sign of trust. They lived together, split bills, and things seemed great. Until one day, she came home to an empty apartment. He left and drained the account. No warning, no legal recourse. Lisa had to start over. Or take the case of Mike, who added his adult son to his account so he could help with errands. The son ended up using the funds to cover his gambling debt. Mike didn't press charges because legally it wasn't theft. These stories aren't rare. They're warnings. Number 12. Should you open a joint checking account? Ask yourself these questions first. Do I trust this person fully? Have we talked about money honestly? What's the purpose of this account? Do we have a plan if things go wrong? If you feel unsure answering any of those, hit pause. A joint checking account isn't just a financial tool. It's a relationship test. Use it right, and it builds trust. Use it wrong, and it can burn bridges. So, should you open one? That depends on your relationship, your needs, and your willingness to set clear rules. But now you know what's really at stake. Number 13. Joint accounts and credit impact. Joint checking accounts do not affect your credit score directly. That's because checking accounts are not considered credit accounts like loans or credit cards. However, if you link your joint account to a joint credit line, like an overdraft protection loan, then both account holders become responsible for any negative activity. Let's say you and your partner go over the limit and never pay back the overdraft. That could damage both of your credit scores. Also, if the account frequently overdrafts or gets closed by the bank, it may be reported to check systems. This system tracks your banking behavior and could make it harder to open accounts in the future. So while your credit score may not drop immediately, your banking reputation still matters. Number 14. Banks can't mediate disputes. One important fact most people don't realize. Banks don't get involved in personal disputes over joint accounts. If your co-owner spends all the money or does something unethical, the bank won't reverse the transaction or help fix it. They see both account holders as equal owners. It's up to you to settle disagreements outside of the bank. If it escalates, you may need legal help. So before opening a joint account, make sure the other person is not only trustworthy, but also financially responsible. Number 15. Joint account equals to shared responsibility for fees. Monthly maintenance fees? Overdraft charges? ATM fees? Yep, they're shared. If one person forgets there's a bill coming out and the account dips into the negative, both owners are on the hook for the fees. Let's say Rachel and Jason share a joint account. Jason buys a last-minute flight, thinking there's plenty of money left. But Rachel forgot about a car insurance payment set to auto-debit. The account goes into the negative, and they get hit with $35 in overdraft fees. Now both of them are paying the price for one small mistake. Number 16. You can remove yourself, but it's not always easy. If things go south, you might want to remove your name from a joint account. Sounds simple, right? Not always. Some banks require both parties to agree to close the account or remove one person. Others may allow you to withdraw and leave, but your name might stay attached until the account is officially closed or updated. And if there's a negative balance, you may not be allowed to leave until the debt is cleared. This can trap people in joint accounts longer than they expect. That's why it's smart to understand the exit plan before signing up. Number 17. You still need personal accounts. Even if you open a joint account, it's a good idea to maintain your own personal account too. Think of it like having two toolboxes, one for shared household tools and one for your personal stuff. Your personal account can handle your private expenses, savings goals, or emergency fund. That way, you're not fully financially dependent on someone else or exposed if things go wrong. Many financial advisors actually recommend the three-account method: yours, mine, and ours. This approach gives you the best of both worlds, independence and teamwork. Number 18. Watch out for scams or abuse. Sadly, joint accounts can be used for financial abuse. In some toxic relationships, one partner may use the account to control the other person's spending, monitor purchases, or lock them out of money entirely. This can happen to anyone, young or old. In fact, elder financial abuse is a growing concern. A dishonest relative may persuade an elderly person to open a joint account and then siphon off their savings slowly. If you're ever pressured to open a joint account, take a step back. Money decisions should always feel safe, clear, and mutual. Number 19. Taxes and joint accounts. Money earned and deposited into a joint checking account doesn't automatically trigger taxes, but interest earned does. Let's say your joint account earns $40 in interest for the year. That interest is typically reported to the IRS under the primary account holder's Social Security number. So if you're listed as the primary, you're the one who may receive the 1099 INT form. You may need to report that interest income on your taxes, even if you split the account with someone else. So talk about taxes early, before the forms arrive in the mail. Now it's your turn. Would you open a joint account with someone? Why or why not? Let's hear your thoughts in the comments.